Lakshmi Narasimhan, ED at Shriram City Union Finance. Lakshmi, thanks so much for taking the time out and joining again. Now, you have a high portion of borrowings from banks at 59%. How much do you see your cost of funds rise, and by how much has the cost of borrowings also increased for you since 2018?
Yeah, thanks so much. At the beginning of the year, we had projected anything like a 20-25 basis points increase in our overall cost for the year. But that's already been challenged, and as we speak, my marginal cost of borrowing has gone up by 40 basis points. Just to hedge, there are certain customer segments where we have also increased the lending rate effective 1st September. So I think I would budget for another 20 basis points increase for the overall year, meaning thereby that 50% of my borrowing which is exposed to variable rates will go up by 60 basis points for this financial year. So the overall impact should be about 30 basis points in my cost of fund for the full year.
Historically, when we've seen such spikes in the cost of wholesale borrowing, how exactly have you ensured that your NIMs don't come down? Because markets are getting worried about it today. Oh my God, wholesale cost of borrowing will go higher. But this is a cyclical effect. And it's not that bond yields have not gone here in the past. In the past also they've gone here, and yet companies, they survive. So what is your plan in place to ensure that the NIMs in your volume business does not die down?
See, first thing is, in the past what we have done is we have only selected certain segments of customers where the pricing is a little elastic. Say for example, two-wheeler is not elastic. We are already at a peak rate in terms of 25-26%. So we do not see a possibility to increase lending in that book. Whereas the SME segment, where the ticket sizes are up to say 10-12 lakhs, there even in the past we have seen it being elastic, and this time again we are seeing it being elastic, so we have increased it there. Just to let you know that my asset side is completely locked in terms of yields. So the ones that I have already deployed will continue to earn at the old pricing, and the ones that come up new for certain segments we've increased the pricing. But just to kind of add, in a tenor of about 3.5-4 years, which is the weighted tenor for the book, normally you see a couple of rises and a couple of decreases. So when the wind blows favoring you, you get that higher spread, and the wind is against you, you get it lower. We have guided for anything like a 40 basis points drop in the overall NIM from my March closing of 20.1%. So we expect the year to be ending at about 19.5, 19.6. That's baked in already in all our calculations and all our analyst meets.
Do you have pricing power, and by how much has yields risen due to higher funding costs? Or how do you kind of work in the margin impact because of that?
See, one is you try and change the mix of borrowing as well. So you go a little short in terms of borrowing just to ensure that your spreads are intact. We have not done that yet for this financial year, but as we kind of head deeper into the year, and if the pricing is going to go beyond 60, so maybe we go a little short in terms of borrowing. Overall ALM should not be impacted because I am still plus in terms of the ALM. So I may have a position there in terms of going a little short in terms of the borrowing costs.
Could you give me a profile of your current borrowers? When you say that you like to lend to customers where there is a degree of pricing elasticity, so how much of your current loans essentially are fixed, and how much of your loans are flexible, or they are linked to perhaps floating rates?
No, my entire loan book is fixed in terms of the lending rates. When I said there is elasticity, for certain segment of customers, normally about 80% of my book on the SME comprises of traders and service providers, where the ticket size is about 8 to 10 lakhs. In that segment, anything like a 25-40 basis points increase in pricing is something that we have experienced in the past, which we can increase even now, and that is what we have done effective 1st September. Overall, on the loan book, when you look at it, just about 40-45% of the incremental lending will be able to absorb that higher pricing. 55% of the lending that we do is something that will not be able to absorb the higher lending. So, well, that's the story.
Your cost of lending currently is higher than that of the banks, and the reason why that is there because you borrow also from the banks. Can that make you slightly less competitive because banks also are trying to lend again, especially the good quality banks, because the NPA problem is now getting sorted. They don't need that much capital to keep on doing provisioning. So whereas NBFCs like yours have benefited because they've managed to gain business from banks in a falling interest rate regime, could the reverse happen because banks will get more aggressive and they will have better rates to offer?
No, I think the customer segment that we deal with, there is still a pretty high entry barrier. You need more of a collection setup to be on the ground rather than just the ability to lend at a specific price. So the segment which we cater to is normally the customers who are not touched by banks yet. There are some small finance banks which are present in the segment in which we are present in, but that's very localized. So I do not see banks of the size of, say, the SBIs and ICICIs of the world coming to this segment yet.
You do have a large exposure to both gold loans as well as two-wheeler finance too, and both the segments, as we understand, are seeing immense amount of pressure build up. How is it that you are sussing out this entire situation?
No, like I mentioned at the beginning, on the two-wheeler side, we underwrite about 100,000 bikes a month. So I do not see the possibility of increasing the pricing in that segment. There again, the tenor is about 18-20 months. So we will need to proceed the way that we are doing at present, absorbing part of the incremental cost as far as two-wheeler is concerned. And as far as gold is concerned, it's largely a 3 to 4 month book. So I can borrow short in that place and keep my spreads intact, which is what I mentioned as well. As we head deeper into the financial year, just for the gold loan lending, which is about 13% of my loan book, I may borrow a little short and ensure that my spreads are intact.
Growth in loan book from other segments, two-wheelers, MSME?
Sorry. We are looking at an 18 to 20% growth for the full year in terms of loan book. And two-wheeler has already grown close to 20% during the first quarter. We are seeing that trend continuing even during the festival season as we head into October, November, December. So I do not see a challenge on the growth book yet. It's just that the mix of borrowing may alter a little as we head deeper into the financial year.
Okay, Lakshmi, appreciate your time and thank you for very patient